shape or standard. Our rates are something that you wouldn't come to at first choice. In other words, if you're a well-qualified borrower, you're going to see Rick at RTC. If you've got a little something out of the box, or you've got lots and lots of assets, or some of the other odds and ends that Don at Morgan Stanley can share, you go there. You don't come to us until you've exhausted all other methods. And what we require is nothing more really than equity in a property or down payment. So if you're buying a property, we kind of go back to the old days, the old methods of lending. We look at the asset and we say, hey, you know, they're coming in with 35% down. They feel like they can qualify. We've looked at it. We've got some reserves remaining in the bank. We're going to make them a loan. We like the asset. We believe in the borrower. And that's pretty much it. The loans are quick. They're easy. They're simple and straightforward. They are expensive. And so you don't use us unless you really need to, and it's more or less a means to an end. You say, gosh, I've been locked out of the mortgage market or the housing market for a number of years. I think there's a great value in buying today, so I want to buy today under the types of pricing and the properties that are available to me. I've got a sizable down payment, either I liquidated a stock or I sold another property or what have you, and I see the value in buying today. And I know that in a year or two or three, I'm going to be able to go to RTC or to Morgan Stanley and get a traditional loan. And so it really just becomes a math problem at that point. You look at it and you say, you know, I'm probably buying it a couple $100,000 less than what I could have bought 2, 3, 4, 5 years ago, or maybe even more than that. You found a great deal somewhere. And I realize that I'm probably going to pay another $40,000, $50,000 in both fees and interest over the time that I might have this loan. So I'm going to have the loan 6 months. Maybe that's the end of my problems. That gets me over my credit hump that I have, or gets me to this next tax return or this next season or wherever I have to be. And I'll have this loan for 6 months, 18 months, 2.5 years. But I understand that either the mortgage market, the traditional mortgage market, is going to loosen up, or I'm going to be in a position where I can qualify for that type of loan. And so you use us as more or less a bridge type loan. We'll do owner-occupied loans in the same manner. We'll do non-owner. We'll do second homes. We'll let you buy lots. You can buy commercial property. You can buy mixed-use property where it's commercial and residential. There's a lot of places like that here in Laguna. We talked about appraisers earlier. We use local appraisers that are independent both of our company and of any broker, any mortgage broker, any real estate agent, so that not only do you get a fair shake of where the property is from a local experienced appraiser, but we can go back and look at our investors in the eye and say, look, we used someone who was a non-interested third party. He's 10 years experience. He's appraised residential real estate forever and so on. Okay, so we feel comfortable, you feel comfortable, and so on.
No construction loans, right?
We'll do some construction. We touched on it the other day. We'll do more or less construction completion. So to that spec builder or that homeowner that's gotten 3/4 of the way down through his project, and he said, gosh, I'm out of money, or my bank won't lend me any more money, or my bank went under, or whatever the case may be. I'm 75% of the way through the project. And we can go out there and look at the project and see it, feel it, touch it, and go, yeah, I see what the vision is here, we see where it's at, and there's still sufficient equity in the property, meaning that we look at that property and it's worth $3 million, or $2 million, or $1 million, and he only owes, it's worth $1 million, he owes $500,000, he needs a couple $100,000 to get to the finish line and create that additional value. We'll give you that kind of a construction loan, but not a ground up. So it's more or less what we won't do than what we will do. What we won't do is unentitled land. So if we were out buying 60 acres out in Riverside and it had no entitlements on it, it wasn't subdivided, it didn't have any kind of city or county approvals, that's not for us. Ground up construction loans we just mentioned. Borrowers who, by any stretch of anyone's imagination, look like they're a candidate for bankruptcy. We're not going to provide that person a loan. That's probably the only times that you wouldn't get a loan. with us. It's really, again, more about equity. If you're going to buy a $700,000 home, and you said, Eric, I'm going to put 35% down, my hard-earned money, or the money I've gotten from my grandmother, or what have you. And, you know, it's pretty simple for us, because we look at today's values and say, you know, that $700,000 home was probably $1 million or $1.1 million 4 or 5 years ago. It's gone through its cycle. It's the values have come down. Now, on top of that, this person is putting 35% down. They're going to get the loan. The downside to all of this is the rates are expensive. They're typically between 9.5% and about 11.5%. They're based on a 50-year amortization period, so we try to keep the payments low in that respect. And the fees are higher than you'd pay in the bank as well. But you kind of have to look at it back to yourself and say, if you were investing in real estate today, what would entice you to lend money, you know, with all the quagmires that can happen when you lend somebody money and they don't pay back and you go through the foreclosure process. So again, it all boils down to a math problem. If you look at it and say, hey, I know it's expensive, but it makes sense for me, or I need to refinance my house because I've got to save my business, or I have to refinance my house because I'm going to buy another one and renovate it and sell it for profit. There's a million reasons. I'm getting a divorce, I can't qualify, I got to pay him off or her off or what have you. There's dozens and dozens of reasons. So just think of us as more or less, you know, on a need basis. You wouldn't do it to refinance to get a better rate. I don't know what your situation was, but I'm assuming most people refinance to get a better rate. There's a certain segment of the population that refinance to pull cash out for business reasons. We're that kind of lender for that. So some of the other odds and ends, we'll do loans to foreign nationals. So if you have no citizenship here and no social security number, we can make you a loan still. If you're going to buy a high-rise, it's virtually, maybe Rick can attest to this, I'm guessing it's pretty difficult still to buy in a high-rise.
Definitely more difficult than 4 stories or less.
Right.
It's a whole different category. Money's available, but it's more
that may be a Morgan Stanley deal in that case, but I'm just throwing out some examples. The mixed use is a good example. A retail center, properties that are a little quirky or unlendable. They had somebody ripped out the kitchen and the bathrooms, and he said, hey, I know I'm going to go in there and fix that place up, but I can't get a traditional loan. All of those reasons we're sort of a backstop for. So, you know, if the need arises, we're there. I'm going to tell you in 5 minutes. I think we can come out of it. Thanks for listening.
Could you do something that's like it would be like zoned on like kind of like ag, but is there a gentleman's ranch?
Yeah,
You know what I mean?
yeah. Let's look at it a different way too. Any property that we can wrap our arms around and look at it and say, you know, God forbid something happens to this borrower and he's unable to make the payments.
Right.
Is that a property that's at least marketable enough that we can discount it and liquidate it if they didn't make the loan and make our investors happy? If we can answer that question, then you pretty much get the loan. So a zoning issue is certainly an issue.
Because I see those that they're not working farms, but there's just enough. They raise enough horses, they grow enough apples where we're even from a non-conforming standpoint, we're not comfortable with it.
Exactly. So we're the catch-all for all that. So thanks for listening. I know it's not the most exciting topic, but